RBC's Mark Mahaney is out with a new note laying out which tech names are best positioned right now and post-pandemic. He joins us now. Mark, welcome.
Hey, Kelly.
What's the main difference between the names that you like now and the names you think that will work post-pandemic?
We are trying to be somewhat contrarian. So, look, I like Netflix, I like Amazon, so does everybody else. What I am looking for are names that fundamentally have not yet recovered. Those could be travel names, online travel names. They certainly haven't. So Booking.com, it's one of our 3 top picks. And then the ride-sharing names haven't fundamentally recovered either. They're still showing 75% year-over-year declines. Unless they are structurally flawed, unless they're going to be structurally impaired and we just are not going to Uber like we were in the past, which I think we will. If that happens, there's a recovery there. There'll be a removal of some overhangs. They move towards profitability. I think you could see a material re-rating in Uber like we've seen in some of these other stocks like Spotify. And then the one we also like in terms of our top 3 picks is Facebook. I think there's people underappreciate how much of a V-shaped recovery opportunity there is in the internet ad space.
So online travel, ride-sharing, Facebook, these are names that you think should work for the remainder of the pandemic. What about after that fact? I mean, whenever we get there, we pray it's sooner than later at this point. But then what kind of investments would you recommend?
Oh, I'm sorry, Kelly. So let me try this. Those are what I would call recovery stocks. So I think the market's already sort of anticipating what will work post the pandemic, and sometimes will be pandemic on, sometimes will be pandemic off in the market. The best defensive stocks, if we're going to continue in shelter at home, or if we're going to have to go back to that in the future, those best stocks are the ones that the market's already figured out. I think Netflix, Wix, streaming names like Spotify and Amazon. Online retail has been a clear structural win from this pandemic. Look, we all have to keep shopping. We're going to have to force to do it from home. And then all that other entertainment spend, the travel spend, the movie theater spend, all of that's kind of gone into our online retail pocketbooks and wallets. So I think that's online retail. The longer we stay in the pandemic, the stronger online retail will be, and that'll continue to lift names like Amazon.
Mark, I wanted to ask you specifically about Amazon because Walmart announced that it would be offering a subscription-based service, Walmart Plus, and we saw shares of Walmart climb 9% on the week on optimism surrounding that offering and the potential business that would bring to Walmart. Do you see that as a negative in any way to Amazon, or even just proof that there could be competitors out there that had not existed before?
Yeah, Melissa, that's a fair question. I don't want to sound complacent about it, but I think it's just too late. We did our annual survey work. We've done it for almost 10 years now on Amazon, and we're seeing an inflection up in Prime subscribers to Amazon. In other words, Amazon at the beginning of the year announced a date 150 million global Prime subscribers. We think they're going to end up with close to 200 million by the end of this year. And it's maybe not too surprising that you probably had a lot of people on the cusp. I buy from Amazon, but should I sign up for Prime? You go through COVID where all your purchases shoot up. You sign up for Prime. I think Walmart trying to dent the Amazon Prime program at this point, it's just too late. They should have done this 5 to 10 years ago.
Right. And I also wanted to ask you about the impact, the fallout from Tik Tok. We've seen names like Pinterest and Snap rise. Is that justified? Will there be a benefit, or would there be a benefit if TikTok got banned in the U.S.?
I think there clearly would be. I don't think it will get banned, but that's out of my league. Look, in terms of the demographic overlap, as you know, the demographic overlap is very strong between TikTok, young people, millennials, Gen Z, and Snapchat. In terms of the use case, the overlap really is with things like YouTube and Instagram. And so either way, you shut down TikTok, and TikTok's been phenomenally popular based on survey work we've done. I think you'd have a lot of people would be looking for that kind of functionality, and they'd flip over to the other sites. I think it'd be a positive for Snap, Facebook, and for Google YouTube. I don't think it'll happen, though, but that's how it would play out if it did.
Mark, let me flip back to the ride-sharing play that you mentioned. You emphasize Uber in particular, and you've actually trimmed your price target on Lyft. Why do you think Uber's going to have the upper hand here?
Well, look, we like both assets. If Uber is going to re-rate, chances are Lyft will too. So then the question is, which stock do you prefer? We do, and we've always had a preference for Uber. Look, they've got 70% market share versus 30% for Lyft. You, in the history of tech, have made more money buying a market share leader than a market share laggard. Secondly, Uber has got strong leadership position in global markets. So that means their TAM, total addressable market is fundamentally bigger than Lyft's. And then third, we think, this is just a guess on our part, that there are real synergies between ride sharing and Eats, the food delivery business. If that's true, Uber has those potential synergies, Lyft doesn't. So the preference for us is Uber.
All right, Mark, thank you so much, sir. We appreciate it.
Thank you, Kelly.